Welcome to the March monthly update from Principal Wealth Partners. I'm Julina Ogilvie, partner and wealth advisor, joined once again with Bob Paolucci, our founder and CEO. Bob, we are back at a very interesting time. We were planning this monthly update, and as we were doing so over the weekend, we found out that there were three unique bank liquidity issues. The most popular one being on Friday with Silicon Valley Bank. Really, we haven't seen one this size since the financial crisis, followed by two more. So we thought we would kick off this presentation addressing what happened, why is it unique, and what are some of the implications that we should be aware of. And then what we'll do is we'll transition the second portion of this presentation into some of the key market issues that we continue to focus on, if that's fair.
Sounds like a plan because they are going to be related. So,
yep.
Yes, let's cover the banks first. And just a reminder that nothing creates investor and depositor and market fear like banking issues, right? This goes back to the savings and loan crisis of the late 80s, the financial crisis of 2007 and 8 and 9. Where there were massive bank failures, primarily because of toxic investments and toxic mortgage-backed securities. Today, it's very different, very, very different. And let's talk about it.
Okay, sounds great. I know we have prepared a couple of slides that are talking about the banking issues, so let's pull those up.
Yeah, so the bank that's been in the news, if everyone's been listening, is a bank called Silicon Valley Bank. Silicon Valley Bank was a very unique bank, a major lender to venture capital companies. So new companies in the tech sector, the biotech sector, venture capital companies, which are private equity funding companies, would help some of these private companies become bigger companies and eventually go public. So there was a bank, obviously, in Silicon Valley that would cater to the deposits and operating accounts needed of any business, but very specific to these types of businesses. And they would also lend money to these same businesses. Now, the requirement at Silicon Valley Bank was unique. Not unheard of, but unique, because this bank was going to deal with large sums of money and actually lend out to these new businesses. They required that those businesses keep all of their cash at this bank. So Silicon Valley Bank has existed for about 3 decades. It wasn't a mom and pop bank. Their depositors were businesses primarily. And most of the deposits at Silicon Valley Bank were in excess of $250,000. And I know that sounds like a lot, but you have to think about it this way. When a lot of these small technology companies have to, make payroll, right? Their payroll might be 10 million a month. So it's very common for business clients to have way more than the $250,000 FDIC limit in a bank account, because weekly millions are coming in and out of these accounts, right? That makes sense?
Absolutely.
So Silicon Valley Bank, very unique. You don't see many banks like this in the country. They were in a bit of a pickle because these institutions, these technology institutions, VC companies, were pulling more money out to pay their staff. They weren't having as much money come in because obviously earnings for those types of companies are down. It's not the best environment for those types of companies to make a lot of money. So there have been a lot of withdrawals, in essence, and not as many deposits coming in. And then late last week, Thursday into Friday, there was a bit of a run on that bank where all of these small to mid-sized businesses were just taking money out because rumor has it Silicon Valley Bank was looking at a liquidity issue. right? They didn't plan ahead. They didn't think that 20, 30, 40, 50 billion dollars would come out that week. And what banks typically do is they have their excess reserves, the deposits that people and institutions make. They invest them in very liquid treasury bills and bonds, some government mortgage-backed securities, all that stuff. All are very valuable. Again, they weren't investing in junk mortgages. They weren't investing in garbage securities. Those regulations have changed. So all of the excess capital that these banks have, really think about it, they're in the government bond market, whether it's short-term bonds, intermediate-term bonds, long-term bonds.
Right.
The problem, Julina, is with some of these regulations that the banks have, let's say, two accounts where they put these bonds. They have an account that is dedicated to holding these bonds until maturity, and they have an account that's available for sale at all times. Okay. So when Silicon Valley Bank sold bonds to create the cash flow that they needed, they had to sell bonds at a slight discount, about a 10% discount. Why? Well, because the bonds that they sold had a lower rate than current interest rates are today. And because of that, those bonds look slightly less attractive. Yes, they're government bonds. Yes, they wanted to hold them to maturity, but in a pinch, they had to sell them. And if you sell a 2% bond in a 4% environment, your bond's going to come down a little bit in value.
Right.
So Silicon Valley Bank was left with a $2 billion shortfall. This is a $200 billion bank. They were left with this tiny $2 billion shortfall. So on Friday, they tried to raise capital to fulfill that $2 billion shortfall, and they couldn't do it. So what did they do? They had to call the FDIC, and the FDIC said, hands off, stop the presses, stop everything. And then the FDIC, in essence, took over the bank. That was Friday night into this weekend.
Right.
So this issue with the banks, this is not an 08, 09 issue. This is not toxic securities. This is not a solvency issue. This is a liquidity issue. Does that make sense?
Absolutely.
So the bank was not able to turn securities into cash quick enough. Yeah. And because of that, they had to report that to the FDIC. And here you have the government now handling the deposits of this bank. All of those depositors at Silicon Valley Bank are going to get their money, right? The government stepped in on Sunday to say, okay, this is a very different situation that this bank is facing, and maybe one or two or three other smaller banks across the country might be facing. And it's really due to the Fed increasing interest rates so quickly and by so much that the bonds that all these banks want to sell are worth slightly less.
Right.
That makes sense?
Absolutely.
Okay. So what the Fed did is they announced a program for these banks to exchange those slightly discounted government securities back to the government at full face value. So there is no discount when you do this swap. And for these banks to have full access to cash.
Right.
In a weird way, Julina, this is the Fed saying, oh, we're the ones who created this by moving rates. We didn't think about this. We were solely focused on employment and inflation. And we apologize. We're here to help. So that is what happened. Now, the questions that our listeners might be asking, is my cash okay at my local bank? Yes, your cash is okay at your local bank. Again, this is a very, very unique situation that maybe a few banks are exposed to, none more exposed than Silicon Valley Bank because of the nature of their client base, which is mostly businesses, and the fact that most of the depositors, how about this one? Most of the depositors have more than the $250,000 FDIC limit.
Sure. Yeah.
So, yes, your local banks should be just fine. Again, if you want to be more cautious. If you have more than $250,000 in a bank account, you can talk to your bank about how to re-register your accounts. In other words, if Julina, you and I had a joint account, that account with me first and you second would be covered for $250,000. We can open up a second joint account with you first and me second, and that would be an additional $250,000 worth of coverage. So talk to your bank if you do have any concerns. However, I should point out that any cash held with us through our custodian Fidelity Investments, the cash account that our clients have through Fidelity is 100% backed by U.S. government securities. There is no price change, completely liquid, and there is no limit to the guarantee provided by the government. On top of that, there is north of a 4% yield, closer to about 4.25%. So if you're listening to this and you have excess money sitting in the banks, let us know. We can pull excess money from your bank for you. If we have the bank account linked to your investment account, you can send us a check or we can give you wire instructions. That's pretty easy to do.
Absolutely. And I think, Bob, thank you for all that detail. It's very helpful. And I would also stress that what your comment just now on how unique Silicon Valley is, when you look at this loan to deposit ratio that we have up on the screen, they're down on the far right, well away from the other banks.
That is correct. There was this small bank in New York, Signature Bank New York, it was called. They had cryptocurrency related issues. They were also taken over by the FDIC. And then the trigger for most of this, I actually think, was going back to Wednesday. This tiny banking institution called Silvergate Capital went out of business. They were solely focused on the cryptocurrency market, right? And as you can imagine, that area of the market, I hate to even call it a market, but cryptocurrency related activities have decreased dramatically, and that market has become quite frozen. So any of those small banks that were solely focused on the wave of the future that is cryptocurrency, they're in harm's way. But again, that's not going to be your mom and pop bank. That's not going to be your local community bank servicing a diverse group of people and businesses. These are very unique institutions.
Absolutely. And Bob, not only did the banking regulators approve all of this very quickly, but the Federal Reserve also stepped in, as you mentioned, which is unique. And I understand that they're offering loans to these businesses as well.
That is correct. And that's what they actually announced on Sunday. So Jerome Powell is the one who really crafted this plan, saying, look, we understand what we did. We created a liquidity crunch where banks of all sizes, if they had to sell their government bonds that they bought over the past 2, 3, 4, 5, 6, 7, 8, 9, 10 years, if they needed to sell those bonds have lower coupon rates than what's being offered today. To provide a market offset for the lower coupon, you could still sell the bond in the market, but you're not going to get as much because new interest rates are higher.
Correct.
So if you're going to sell a lower interest rate bond, you're not going to get par value back. You're going to get slightly less than par value. So the Fed has created this lending facility for all banks, where they can take those treasuries issued by the Fed, and place them with the Fed. And the Fed will just wait until they mature in exchange for cash at the banks.
Right.
Very simple. And again, it's for banks that need to take advantage of it. So, really for any bank that needs to take advantage of it. However, that doesn't quiet the narrative of there was a run on a bank or two or three, and that there's fear in the banking institutions again. So you're seeing a little bit of market volatility, specifically in the financial sector, where, generally speaking, as of right now, all of the banks are down in value. So meaning them as a publicly traded company, the shares of their stock, they're all down because of the uncertainty. I do think that creates opportunity, just like it did in 08 and 09. There's certainly risk, and I think the risk is really around the lower tier banks who did not have chief risk officers, smart CFOs, a proper allocation of how much to put in that hold to maturity bucket versus available for sale bucket, right?
Exactly.
It's just like running your own finances. How much do you put in savings, to be held for a rainy day? How much do you put in your working capital account? And, to simply summarize it, some of these banks are being sold off because of the amount they have in their working operating account versus their savings account, where it needs to be moved over, really wasn't maybe as much as needed.
Okay.
Not that big a deal, but it does create a bit of a liquidity issue short term.
Absolutely. And I think just one more point to drive home what you said before, which is so critical in this conversation, is that this was not a mom and pop type of bank.
Exactly. So if you look at the breakdown, this is the Silicon Valley breakdown of deposit funding. Mm-hmm. So you see that the largest exposure that this bank had was to early stage tech companies, tech companies that are just beyond early stage, life sciences and biotech companies. They had some international exposure, U.S. global fund banking exposure, private bank exposure. So again, the vast majority of their deposits come from institutions, and the majority of their deposits come from the venture capital-like companies. So you typically don't see this mix anywhere, but with Silicon Valley Bank.
That's great. Thank you for going through that. Mm-hmm. And you also mentioned earlier that this certainly has implications into the market. If you can maybe talk a little bit more about what that looks like.
Absolutely. So why don't we go to the yield slide that we have put together, Julina, which is right after that slide we just put up there.
On the money markets.
And that's right. And, to fully explain to you maybe why money is flowing out of banks, I think we all can see that our checking and savings accounts yield us very little, right? It went from a yield of almost zero to a yield of maybe if you're lucky, 0.5%. Mm-hmm. At a time where, if you've been listening to us, we've been buying short-term treasuries for our clients. We're telling you about our money market through Fidelity that yields about 4.5%, 4.25%. When there's such a spread between what your bank is paying you for your deposits of less than 0.5%, probably even lower, and what you can get if you buy short-term treasuries, which are guaranteed with no limit, mind you.
Right.
What you can get with the money market that we use at Fidelity, 4.25%, 4.5% with no limit, 100% guaranteed. Mm-hmm. It's creating this drawdown of deposits from the banks, right?
Exactly.
And the biggest banks understand how this works, and they allocate their operating accounts, their liquidity accounts appropriately. But some of them don't. And that creates a temporary shortfall. It's more of a liquidity crunch than it is a solvency issue. These banks have the money. Silicon Valley Bank has the money. They just had a funding shortfall. But because of that, the FDIC had to come in. So all those depositors will get their money back. Under 250, much quicker. Over 250, it won't take that long, but they will get access.
Yeah. And would you also agree, Bob, that the money that flowed into the banks, especially during the pandemic, were at extremely high levels that we had never seen before?
Absolutely, right. So if you think about the PPP loans, the forgiveness, the employer retention credits, a lot of these government programs, that were available to businesses
Mhm.
on top of private equity funding of startups and new businesses and new ideas. There's just been a massive amount of capital being deposited at banks, whether it's coming from the government or private equity into these institutions. All that cash was created and it has to go somewhere. So Silicon Valley Bank, I don't have the slide up here, but them specifically, they had about 19 billion in deposits as of about 3 years ago. And as of about 3 weeks ago, they had almost 200 billion.
Amazing.
So, I mean, that's just a massive shift.
Sure.
So how they were depositing those dollars behind the scenes, allocating to government securities, and how much goes into savings and how much goes into the operating account. Again, it was very hard for them to figure out the right mix because it just happened.
Right.
And, I think across the banking universe in the United States, certainly a lot of that cash inflow has happened. But according to the various charts, most of those banks have kept a lot more in their operating account in the event that there was a drawdown of money.
Yeah, absolutely.
So certainly the dynamic of the pandemic influenced financial support, fiscal support, the PPP loans, the employer retention credits, the creation of a lot of cash certainly made it more challenging for those not so experienced banks to allocate capital appropriately.
Right. Okay. That's great. And I think another implication of what occurred over the weekend is really just on yields in general, if you can address that.
Absolutely. So yeah, let's close out for those that don't want to watch any further. If you just want to hear us talk about the banking situation, your banks are going to be fine. There was a chance that there could have been a bank run as soon as today if Jerome Powell didn't decide to create this funding program. He knows clearly the PTSD of banking crisis and financial credit concerns, what that can do for depositors, not even investors, just people that have money at banks, on top of investors, on top of the media sending out signals and making you nervous, on top of social media now making people nervous. And what's very different today is more people have access to their bank accounts online to just move money in a pinch without thinking. So in order to provide protection for that, in order to quiet the narrative, the Fed made the appropriate steps to control this. So we aren't going to have this widespread banking issue because of the Fed and their ability to assist the various banks. And again, it's really to provide liquidity quickly. The banks have the money; they just need to be able to provide liquidity quickly if needed.
Yeah. And I would also stress that the banks are much better capitalized, especially since the financial crisis today, than they ever have been before.
Significantly better capitalized. They have more money, and where they put their money now is in government securities or government-backed securities. So, liquidity is actually very high. It is just the unique situation that rates have risen substantially over the past year, that, the bonds that were purchased prior to this past year were at lower rates, and those that haven't matured yet are down in value slightly. But again, down in value slightly, if you need to sell a bunch of them, creates a funding shortfall. And if you have a funding shortfall, you might have to call the FDIC. So again, at maximum, a handful of banks would be exposed to this. 3 were. But the Fed is doing the right thing by not allowing any more to be exposed to this and to quickly shut down the narrative. In the market, there's some repricing of financials related securities, and I understand that that'll probably happen for the next week or so, but that will create massive buying opportunities, just like 07, 08, and 09 created massive buying opportunities for some of the financial sector securities. We think that will be the same. This is now related to what the Fed is doing, Julina. So the pivot here that we're going to make is into the Fed likely being done with their interest rate increases. So, when we were putting together our narrative for our talking points for the market outlook, there are three things that we think are in the way of the next equity bull market. The first one, and this is chronological order, the first one is the Federal Reserve. Will they, prior to the past couple of days, we were going to say, when are they done increasing interest rates? Is it at this meeting or the next?
Right.
The narrative coming out of the Fed and their voting members is that they might increase by 2 or 3 more quarter point increments. And I think it is absolutely done as of today. So I think the Fed, who is set to meet next week, I think they're going to announce that they overdid it. Their narrative was too strong, and that they are now done increasing interest rates. I would tell you that the bond market has already priced that in. Not only has it priced in the Fed stopping, this weekend it priced in the Fed cutting rates. And we'll show you that in a minute. And then we have corporate earnings for the first quarter coming out in the second quarter, which is April, May, June.
Sure.
First quarter earnings came out quite good.
Yeah.
Certainly better than expected, but expectations were lowered.
Yeah.
But I think we've been in a negative fog mentally for the past year that better than expected earnings aren't trusted, especially when you have negativity swarming, a bit of a black cloud above us.
Right.
So I think the market wants to see another quarter of not so bad, better than expected earnings. So I think Q2 earnings are going to be important, reflecting Q1, again, coming out in the next 2 months or so.
Right.
And then the third, which is going to be sometime around the end of summer, is the debt ceiling.
Correct.
We are going to have a separate video that we're filming, and that will be sent out separately, where we talk about the debt ceiling. But the last thing we want is for there to be a down to the minute negotiating of the debt ceiling.
Correct.
Because that means a credit downgrade for the United States if we were to default, which we have never done in history. And that would just create more market volatility. So there are 3 hurdles in the way of the stock bull market. As we mentioned in prior videos, we're already in the bond bull market. But the stock bull market, we really need these 3 dominoes, these 3 hurdles, in essence, to be cleared. And again, to recap, it's going to be the Fed needs to stop, earnings need to come in okay, and the debt ceiling needs to be resolved.
Correct.
And we should clearly have our equity bull market. Now, our opinion has changed slightly as of this weekend because of what the past couple of days created. We think the Fed may have shown their cards. It's going to be very hard to increase interest rates by any more, seeing that your rate increases have created this liquidity issue amongst the banks.
Sure.
Meanwhile, Julina, if higher rates and increases created this liquidity crunch, what do lower rates and cuts do?
Right.
They provide liquidity. There's no more crunch.
Exactly.
So I think the Fed clearly knows what it has to do. And I think we will see that play out very shortly.
Okay.
That is good for all markets. That's great for the bond market. That's great for the stock market, right?
Absolutely.
So finally, we might get that signal from the Fed next week at their meeting that they are done. Inflation is no longer going to be an issue. Seeing that the number is just going to continue to come down, at least for the next 6 months.
Yeah.
And I think that might be the 4th most important topic, no longer the most important topic.
And if that's in fact the case, there are a lot of economists, strategists that were predicting that rates weren't going to come down until next year.
Yeah, and I think those people just like to hear themselves talk, to be honest with you.
Okay.
It makes no sense whatsoever. Those are just talking points.
Right, I know that you were in a different opinion of that.
We've always been in a different
Yeah.
opinion. Let's pull up the futures curve
Sure.
to show everybody what we're talking about. This is going to be a difference of 5 days. So 5 days ago, the bond market was expecting rates to look like this. And this is short-term rates.
Right here. Yeah.
That was the green line. So what you see there is, if you listen to the Fed, the bond market was pricing in about another half a point or 3/4 of a point as of 3/8. So last week, which is the green dot chart. And then as of this morning, you have the Fed maybe being able to squeeze in a 1/4 point increase. And then you have cuts in before December. You actually have, according to this chart, 75 basis points of cuts now being priced into the yield curve. So how quickly things can change.
Exactly.
If they did a chart like this as of this past Friday, it would look similar. We just didn't have the chart as of Friday to show you. We had it as of Tuesday or Wednesday. So literally over about a handful of days. Meanwhile, most of those days being the weekend, we have had this dramatic change in the pricing of interest rates looking forward.
Exactly.
Yeah.
And I think the next slide as well is falls into the same conversation.
Absolutely. This is a picture of the longer view of the yield curve. So whether it be a 3-month bond, a 6-month bond, a 2-year bond, a 10-year bond, a 30-year bond, every single fixed income security is now yielding less, pricing in a new environment forward, which is a lower rate environment going forward. And rates are lower across the board.
Exactly.
Yep.
And part of this conversation, you referenced it already, and we've talked over and over again about it, is inflation, right? And how fast it's coming down. And that was part of the Fed's reasons for continuing to raise rates. But if you could maybe share with everyone where we think that is, I think this is a great visual.
Yeah. It's amazing what a red line that we drew on this chart will do. And it's really to get you to understand the first half of last year on the left, the second half of last year on the right. And these are the monthly inflation numbers that have rolled on. On the left, they were very hot first half of the year. On the right, they were very cold. The average roll-on rate was about 0.3. Right. So the average for the first half per month, we were looking at about a full point every month. What also has to be understood is that we're about to have those numbers on the left roll off.
And as a reminder, Bob, the inflation number is a 12-month rolling number. So when you talk about rolling off the number from 12 months ago, as that disappears, which are all the ones on the left-hand side of this page, you can see the natural transition of inflation going down. Absolutely.
So on Wednesday, the February inflation number for 23 is going to roll on, and last February's 0.7 is going to roll off.
Exactly.
If I'm a betting man, I believe the number that's going to roll on is going to be much less than the number that's rolling off. I would wager a lot on the March number that will come out in April. A lot less than the 1.0 that we saw last March. I'll call April a push. And then 2 other whoppers are going to fall off. That's May and June. So as we get into June and July, the May and June numbers will roll off. And I'm quite confident that those red hot numbers, the hottest numbers we've seen in 30 years, are going to roll off. And what's rolling on is going to be much cooler. So I'm going to make a prediction that the inflation number will have a 3-ish reading, potentially lower, come July. Great. Come July. Will it stay there? Well, I think it'll now be range bound for the 6 months after, to the tune of about maybe 3 to 4. on its way closer to 2 next year.
Exactly.
Yeah. So we don't have that inflation problem. And I find it bizarre that on TV, people keep wondering when the 6.5% inflation number is magically going to turn into 3. Well, not monthly, but month over month for the next 3 or 4 months, it will.
Exactly. I mean, by definition, when you look at this page, it can't happen overnight.
That's right. That's right. So this is why we go back to prior videos saying it's really time driven.
Mhm.
The Fed doesn't have to do much more. I think they, months ago we were saying they're marching into uncharted territories with rates this high. Something's going to break. And yeah, they actually broke the back of a couple of banks is what they did. They created an illiquid condition for a few banks, and they realized it. And then Sunday they admitted it by providing a facility to these banks to provide liquidity. So,
Great.
so inflation won't be an issue quickly.
Yeah.
You'll
Okay.
see. Just give it, like we've been saying, just give it until the summer, and the inflation picture is going to be a non-issue. You probably won't even hear about it come summer.
Right. I finally feel that we're starting to see the light at the end of the tunnel on this conversation.
Sure. Yeah. Is that a dig or is that a compliment? I don't know how to take that. So.
Well, I feel like we have been talking. We've talked about this endlessly, and so I think there are other issues, as we alluded to in the beginning of this conversation, that we also need to address. And so maybe we can just move on and talk about earnings next.
Sure. Yeah. So the next chart, let's pull up earnings. Earnings again have come in quite well. Hard to see this chart, but we will provide the paper presentation attached to the link for the video. But what you see here, this is a little old. This was through mid-February, that about 72% of companies came in with above average earnings or above expectation earnings and or met earnings expectations, which is quite good.
Yeah.
So earnings have not fallen apart as many expected they would. Again, the consumer is still resilient, still strong, still consuming. You could rationalize that by they're employed. We have full employment.
Exactly.
Earnings will decrease when we have a major drop in unemployment. When people aren't working. As long as people are working, they'll be able to consume. Not to mention, there's still $750 billion of excess cash from various stimulus programs, which means there's just way too much stimulus provided sitting on the sidelines.
No, that's great.
Yeah,
that's great. And I think the third element that we were going to talk about, which is newer to the conversation about some of this uncertainty, is the debt ceiling. And I know we're going to go into more detail through another webinar, but if we can maybe touch on this a little bit.
We'll touch on it for a minute because we are going to have a separate presentation on this. So the debt ceiling is not it's not a fundamental economic item, right? It is government voting to increase our credit limit in order for the government to pay its bills. And, whether you are on the left or on the right, I think the amount of spending that we've seen over the past couple of years is unlike any other spending in history, right? So to continue to think that we can and should spend like that is crazy. And you have the two parties sort of soon to be fighting over what that debt limit should be, what the credit limit should be, and more importantly, what level of spending we should have, right? What we shouldn't be spending money on. Maybe we can pull back here. Maybe we can do different things. The market has a way of making politicians come together to make a decision. And the way that they do that is the markets get very volatile. Think about it as the markets start roaring. And the politicians who will take the blame for it roaring will lead to politicians coming to some type of an agreement. And we fully expect that to happen. So I even bring this up as the third hurdle, simply because it creates a bit of market volatility. It doesn't mean that companies will have less earnings because of it. It doesn't mean that there'll be, a major shift in the economy because of this. It is just something that the capital markets really dislike, and it will send its message if it has to. I hope that our congressmen and women come together to figure it out sooner rather than later.
Right.
We shall see. We shall see.
Yeah, and I think to your point about the markets getting emotional, that's how I coin it. You can see in past scenarios where, yes, there's been some short-term volatility as we've addressed it, but over when you look further out over a 1-year period, the markets have reacted well on the longer term.
Exactly. The debt ceiling conversations have a way of capping the market, in its path until the debt ceiling talks are over, and then the markets tend to rally up from there. So a lot of this, I would say, is starting to be priced into the market, which is why it's still in a trading range.
Yes.
We have the signal sort of from the Fed that they're either almost done or done. I think they're done because of this weekend. But we had last week and the week before a Fed saying, well, we have a few more and then we're done.
Yeah.
What I heard from that is they're almost done.
Exactly.
So, okay, that's one good thing. Earnings have been coming in line. Now we just need to prove it for another quarter. The debt ceiling needs to get out of the way, and then we'll have our bull market continue.
Absolutely. And I think, Bob, the one thing I would also stress that we continue to discuss is going into 2023, you were very vocal to say the equity markets will continue to kind of move around in the first half of this year. So everything that we've seen so far this year has not been a surprise.
Absolutely. It's what we expected.
Yeah.
The banking situation with these small banks, the Fed was going to break something, moving interest rates from just about nothing to just about 5%. Right. And here we find the broken piece, which is a few banks.
Yeah.
And I think for them, that's the limit, right? So yes, for us, those three major things that we were talking about, the Fed finishing, corporate earnings hanging in there, and the debt ceiling, that's keeping us in this bounce around range. Once we get over those hurdles, I don't want to say it's off to the races, but the equity market will re-enter the bull market phase once we can clear some of these hurdles. We're almost there.
Almost there.
We're almost there. Yep.
Can I say again, maybe we're seeing the light at the end of the tunnel?
We're seeing the light at the end of the tunnel. And for you listeners, you are now understanding why we were so vocal about and so confident that inflation was going to come down. Number one. Number two, we were very vocal about the Fed overdoing it. And for us, why create a negative event if you can avoid it? Why not just increase to above your long-term target rate, which is 2.5, go to 3.5, wait.
Exactly.
Go up by another half if you have to. And then over time, bring it down. Right. So now, hate to spill the beans here. Now the Fed might be cutting rates sooner rather than later and by more. Well, isn't that fuel for a bull market?
Absolutely.
Absolutely it is. So how about that Fed when they were getting upset, when the equity market was starting to rise, when things were starting to get back to normal? It felt like they wanted to see pain in the economy, and now they might be the creator of a market rally. So absolutely. I think they got a little ahead of themselves, but hey, we might benefit from it. So.
Yeah, and I will say more to come. That's why we're going to continue to have these monthly updates. As you mentioned, we will do some more detail around the debt ceiling because that conversation is not going away anytime too soon. So, to all of the clients that are listening, we will come to you with more information, but we appreciate the trust. We are, as I always say, we're here for you. If you have any questions, we're happy to have the conversation with you.
Absolutely. If anyone has any questions about your bank, banking in general, FDIC limits, any limits in general, how things work, feel free to reach out to us, your advisor, even your support staff, service staff. We're all quite well versed in this stuff. We've seen it. We've seen it in the past. We've dealt with it in the past. We know what we're talking about. So we're here to help you. Feel free to reach out to us.
That's great. For sure. So Bob, thank you once again for all the insight.
No, thank you, Julina.